The Warren Buffett indicator has been turning red frequently during 2020. What does that mean for the stock market? In this video, we discuss whether this particular statistic is highly predictive of a stock market downturn or whether it's actually an outdated tool in the world of central bank mania and negative or zero interest rates. Hello everyone, so before we get started, what is the Warren Buffett indicator? It's the ratio of total US stock market valuation to current GDP. And recently, the aggregate US market value is almost double the current GDP. So we're going to discuss in this video exactly what that means and why this indicator is so important for long-term valuation of the stock market. So originally it was called the Wilshire 5000 because back in the early 70s there were 5,000 stocks included in this calculation. There are many estimates of composite market value. Here's another graph showing an estimate now of the total US stock market of around 42 or 43 trillion US dollars. The GDP represents the total production of the US economy and it's measured quarterly. You have to remember with the GDP, it's a static measure of prior economic activity, so it doesn't really help us forecast or look forward as to what might happen with the economy in the future or stock valuations. And another thing to add is we need to look at the average of this particular indicator, and historically that average line, that trend line has been trending upwards. So the average won't be the same as compared to where it was 20 years ago or 30 years ago. So my point there is fair value is a little bit higher in terms of the ratio than it was previously. So with this particular indicator, what did we see back in February, March? Well, we saw it drop all the way down to 1.04, and at the moment we're at levels as of a couple of days ago of 1.73. And you can see that the mean average is at around 0.8. However, if you look back on a longer time frame, you will see why it's so key. Have a look what happened just before the dot-com bubble and crash. Well, this same indicator shot up all the way up to 1.41 before then coming back down. And the same thing happened in 2007. It went up, but not as much, to around 1.05 before then tracing back down. So this particular metric, it does have a track record of predicting downturns. That's why it's considered so important. It surged just before the dot-com bubble burst and also just before the 2008 financial crisis. But let's stretch back to the early 70s to see the longer term trend. And just before I do that, if you think stocks are going up in the next 6 months, don't forget to hit that like button. If you think the stock market is going to capitulate, also hit that like button. So let's have a look. Let's click on all, and you can see we go back to the early 70s here, where interestingly the kind of lowest point for this particular indicator was around August 1982, and back in the early 80s that was a significant bottom in the stock market. And if you remember back then also we had very high interest rates. So what's the fuss all about with this indicator over the last kind of 12 months to 24 months? Well, you can see here now what the issue is. When it peaks up, what it suggests is that the stock market is generally very overvalued, and at levels near the lows here, and I'll show you this on another chart in a minute, there are periods where it's more undervalued. Now, we've been overvalued for a while, but the problem now is we're more than 2 standard deviations away from the mean. So we're significantly overvalued, and we've remained so. In fact, just jumping back onto a 5-year chart, what you can see here is that we've been over the 1.45 kind of mark for nearly coming up to now 3 years. So we've been overvalued for a while, but what we've seen now are historically high levels with the overall stock market cap as compared to the GDP. And potentially, if the stock market continues to rise or even stays at same levels and GDP drops, this could go up further. So one thing to note here, I think, and it's pretty obvious, is this indicator can remain significantly overvalued for a period of time. So that begs the question, is it even an important indicator anymore? I would say if you look back onto a longer term time frame, you always get a regression to a mean. I think it's a natural law. However, that mean level might be significantly higher than it was before. And what we saw in March was an attempt for the stock market to do that, but then central bank intervention, I think, is so key here. So since the 2007 crisis, we've never had a longer period now with very, very low interest rates, even negative interest rates in certain countries. And I think very much Japan style, it's going to remain the same for possibly years to come. So this creates a very artificial capitalist market. And as mentioned recently in my stock market analysis, I think we're in one final parabolic rise to end the bull market. So if that's the case, we will see this number go up, possibly all the way up to 1.8, 1.9. But then we will get a regression back to the mean, but the mean might not be 0.8. It might be in the 1 to 1.2 level instead. The other issues with this type of indicator as well is that they assume things like interest rates or taxes will remain kind of constant over the years, and we've seen recently that's not the case. The other thing it assumes, because remember here we're looking at the US market and we're looking at US GDP. However, what are the biggest stocks at the moment, not only in the US but the world? We're talking about Apple, we're talking about Amazon, Facebook, Alphabet, and these are global companies, not just US companies. So the GDP figure we're using for this calculation is just US GDP. But actually, we should be incorporating kind of world GDP when we look at this particular figure and how it pertains to the US stock market. So what's my point? The actual number is probably a little bit lower in reality than what we're seeing on this chart. So I don't think it's a reliable indicator in terms of exact amount. However, the fact that it's saying we're overvalued, I think that potentially is the case, because you can compare even on this indicator the trend over the last, say, 2 to 3 years. And you can clearly see there, let me just switch on to a smaller time frame, that actually we've been over that kind of 1.00 level for a long time. So the average is probably above 1 as well. And actually, I just mentioned there some of the larger companies. What's interesting is if you have a look at the Dow to GDP ratio, and remember the Dow's price weighted. So stocks generally with a higher price are given higher weight. You can see the number here is kind of much more reasonable, much less overstretched. We're between the 1 and 1.25 mark. It's mainly actually the S&P that looks so extreme. And these levels we've only seen around the dot-com bubble, but also funnily enough, back in the 60s, we were around those kind of levels. So in summary, I think it's a useful indicator to let you know that we are very much in a bubble, not only in the stock market, but probably the housing market as well in many countries. But just like, say, an RSI, a technical indicator, it can remain overvalued for a while. So it's not a timing indicator. Let me know what you think in the comment section below. Do you think these longer term valuation models are actually useful? Or do you think the market is just so chaotic at the moment with central bank intervention that there just isn't any reliable way to see what's coming next? Thanks very much for listening.